All right, this video is all about candlesticks. If you look at the chart, there's a lot of candlesticks. Well, this is a candlestick chart. There's a lot of candlesticks on it. And those candlesticks are giving us a lot of information that we need to analyze. So in this video, we're going to learn about candlesticks, how to use them, how to read them, and what they're telling us so that we can predict price more accurately. So let's jump over to this video.
There's actually three types of charts on TradingView and throughout the world. The first one is something that we're used to, is just a line chart. And so what we talked about with price, this is price on the vertical, and then horizontal is time. As time moves on, price changes, and that can be expressed by connecting the dots of the change, and you will get a line chart. All right. The line chart is very good for identifying peaks, the top of the peak, the bottom of the peak. That's what line charts are good for. And so you can see here, if I could draw a line, I would draw a line right here on the bottom and see that this was an uptrend here, where it's creating highs and lows. Then it shifted where this one created an equal low, and then it broke the low and started creating lower price action. Started going sideways, then it started going down. All right, so that was a line chart, and you can trade off line charts, but line charts does not give you a lot of information on what, it just tells you direction, but it doesn't give you a lot of information on what's happening in these moments. And so what I believe I think it's Japan. I think Japan invented the bar chart with information. The bar chart looks like this on a chart. And each one of these is a segment of time. So let's say this is a 5-minute bar chart. Each one is what represents 5 minutes. So 5 minutes, 5 minutes. If this was a monthly chart, each one would represent 1 month. And what this is based on the time, it says price opened up right here. It opened up right here, and then it went low. Oops, excuse me. I wonder if I can, hold on. Does everybody see my mouse when I move it?
Yes.
Okay, good. All right, so the price opens up here at the open. It opens up here. It went low, and then it started climbing within, let's say this is a 5-minute bar. The 5 minutes starts and price opened up, it went low, and then it traveled up high and went as high as this. And then it started coming back down. Oops. And then it started coming back down. And when the 5 minutes was up, it closed at this level. Right? So that's a little more information than what was given on a line chart. Right? And so visually, individuals were able to trade because they can see within that 5 minutes, or if it was an hour bar, or if it was a 1 month bar, they can see how price traveled within that time frame. And then, of course, the next bar would open up where price closed. So price closed here, the next bar would open up right there, and then that would travel and then close. And so that's what you see represented. For instance, this bar, it opened up down here, it traveled down, went up high, and then closed right here. The next bar opened up right there, didn't go down at all, it just shot up and then came down and closed. The next bar opened up right there, it traveled down and went up and then came down and then closed. Right? And so that's a good visual way to say, not only can we see where price is going, but we can see what's happening within those time frames. And then what we use today are called candlesticks. And candlesticks gives us a little more visual representation of what's happening. And you're going to have two types of candlesticks. You're going to have a bullish a candlestick, which represents green, which means price opened up or price opened up low and closed higher than when it opened up. So it closed higher than the open. Then you're going to have bearish candlesticks, which means that price closed, and excuse me, this is reverse. Let's see. I just caught that. So yeah, this is reverse. So this one's wrong. It should be open up here. So price is going to open at the top and close at the bottom. And give me 1 second. I want to fix this one because I don't want that to affect what you're seeing. So let me fix this really quick. This is an important point to note. All right, there we go. Perfect. All right, so yeah, so now it's correct. So on bullish candles, it closes higher than where it opened. On bearish candles, it closes lower than where it opened. But it's the same concept as the bar chart, where price opens up and you'll have these, what we call wicks. These black lines is called a wick. It shows you the travel of the price. So price opened up, it went low, and then it came back up and it traveled high, and then it came back down and closed here, right? And that's a bullish candle. On a bearish candle, price opened up, and it usually goes in the opposite direction. So on a bearish candle, price will travel up high. It reaches a limit, comes back down, travels low, then retraces back up, and then it closes. The next candle opens where it closes. So on a bearish candle, it would have opened right here. On a bullish candle, it would have opened right here. So when we go down to price action, that's what we see. We see price open, it traveled down, went up, came back down, closed. When that closed, it opened, traveled all the way up, came all the way down, and then it closed. This is called a gap. There's actually a gap here. And so usually that happens from Friday to Sunday, but price gapped down. So it opened way lower, and then it traveled up and then closed. And then it opened right where it closed, traveled down, then traveled up, then closed. And you'll see that consistently happen throughout price, but that's the way that we track price movements. Now, these are called candles or candlesticks. These candlesticks, just like the bar chart, represents time. So if I'm on a 5-minute chart, one candle or one bar or one candle represents 5 minutes. This is where it traveled within 5 minutes. 3 candles is 15 minutes. So it's 5, 10, 15 minutes. That's where price traveled. If I was on a 1-week chart, one candle would be 1 week. 3 candles would be 3 weeks of time, right? And so we're able to see in time what's happening with price. All right, we're going to go a little bit deeper, but you're going to be trading off of candlesticks. And candlesticks tell us an important story about price. So one, on the bullish side, if we're expecting price to go bullish, the candlesticks will tell us a lot about where price is going. So, and I'm just going to point out a few. I'm going to give you this for you to study. We don't really trade off of candlesticks, but it's important to know that when price is heading down, let's say price is heading down, the bears will get exhausted. And so we look for exhaustion by what we call a hammer candle. That gives us this long wick here, which tells us that the bears couldn't close lower. So what happens is price comes down, the bears are trying to push price down, and then the bulls take over and push price up, and the bears are not able to close down low. The bulls push it up all the way up, and the price closes up here. That's an indicator that bulls are taking over the market. And then the next candles start to go up. All right. This is another one where price is coming down and they tried to close and they couldn't close down here. Price comes up and they close right where they opened at. So they weren't able to push price down. That's an indicator that they're going to push price up. I'm not going to go over too much of these. I will point out something on the next slide, but bearish is the same way, where the bulls tried to push price up. This candle opens up here, and the bulls try to push it up, but they can't close. Price comes all the way back down, and they close here. That's an indicator that price is getting ready to go down. Right? So that's the ways that we look for exhaustion in the market. Another piece that we look at is engulfing candles. So like if one candle opens up and it's bearish, and then the next candle opens up and engulfs the entire candle, that's an indication that the bulls are in the market and that price is probably going to go up, and vice versa. If the bulls are in the market and the next candle opens up and you get a bearish engulfing candle, engulfs the entire bull move, that's an indication that price wants to go down. One of my favorite is the tweezer tops and the tweezer bottoms. They're shaped like a tweezer. And so on a bullish move, the price is coming down. And one candle comes down and it can't close and it goes back up. The next candle opens, it goes down and it can't close lower and it goes back up. That's an indication that price is getting ready to reverse and go up. Same thing with the bearish. Price is coming up this way, and then price is pushed and it can't close and it comes back down. Next candle opens up, it can't close higher, and that's an indication that it's going to go back down. All right. Also, the candle size will tell you a lot. Bullish candles that there's no wick, that it opened up, it didn't go down at all. It just pushed up, and it didn't. You don't see any wick on it. That's a very strong bullish candle. The next candle is probably going to be bullish and it's going up. And so this slide shows you the most bullish to a neutral position. So this is neutral. It's like a spinning top where you got wick. It couldn't close at the bottom, couldn't close at the top, so it's kind of neutral. And then the bearish is the same way. It's where you don't have any kind of wick on the top and bottom. And that's an indicator that bears are in the market. It's going to want to push down. All right, so I'm going to give you these two slides for you to rehearse, but they're indications of what price direction is going to do. Any questions on candlesticks at this moment?
Can you explain a little bit more on like when you see those gaps in the market, it just means that it closed the next day either higher or lower, and like a big gap? Is that kind of like the analogy behind it?
Yeah. So gaps are price is going to move connected, and so the only time that you see gaps is if there is a space in time. So usually you're going to see like a weekend gap. where Friday closes and Sunday opens, and Saturday, Friday's night, Saturday, and Sunday, something happened. So like this past weekend, Israel went to war. They weren't at war on Friday. Saturday, they're at war. Market opens on Sunday with a big gap because we have new information. And so you're going to see price gap up or gap down because it's filtering in that information. So you're going to have the weekend gap. And then you're going to have news gap where there's just going to be sudden news that happens that makes the market gap. So for instance, you may have something like we were trading Bitcoin, for instance, and Elon Musk announced suddenly on Twitter, he announced that Tesla and Twitter is selling all of their Bitcoin. They're no longer holding Bitcoin. That was just sudden news, and all of a sudden there was a gap. The price dropped down so quick and it gapped. So that's the reason for the gaps. I think we saw one here. So it'll look like this, where the open or the close or the open of the next candle is gapped away from the close of the previous candle. And that's just
Okay,
based on
thank you. No, that helps. That
news or
helps. Thank you.
Yeah. Good question.
I have a question.
Yeah.
What news outlets do you guys trust or use to kind of keep up to date with what's going on?
Well, usually,
training.
usually we'll use Forex Factory. It has the scheduled news, and the thing with that is that it's proactive. That we know what's coming up for the week that's scheduled. So, like a rate hike decision, Fed chair speaking, CPI or GDP being released. We know when that's going to happen for a nation. But when random news happens, then the market has to be reactive. And usually, to be honest, the best thing to do is Google. So if you're an AUD CAD and all of a sudden it spikes, you type in AUD CAD, you're going to pull up articles from CNBC, MSNBC, Forex Factory, a bunch of different news sources that are reporting why price just moved. And so you'll see that because there is random things that happen. If there was a bombing that took place, or if there was BRICS nations decided that they're going to hold their oil supply, or something happens across the waters and there's a tsunami coming, or a hurricane is coming, or some big factory shuts down. Usually you have to be reactive, and there's a lot of different places to get that kind of news. For the most part, we're not looking to the news. The market's going to tell us what's happening. We just follow the price action. So like, oh, it's going down. It's probably going down to structure. Let's run down and wait and see what happens at this structure. So, good question.
I have a question.
Yes.
I see on this candle chart right here, and we were just talking about the gaps in the market. Now I see there's it looks like a gap and a wick right next to it. Is that called a wick?
Where
The
you
upper
look
wick?
right here?
No, over more to the right. More right there.
Right here?
Uh-huh.
Yep, that's not a gap. So that's actually price action. So
Okay.
price closed right here on this candle,
Okay.
and it opened right here. Then price
Okay.
went up, then it went down, and then it closed right here.
Okay.
And so this is called the body of the candle.
Mm-hmm.
So the body is going to contain the open and the close. So when it's close together like that, what that says is that it closed close to where it opened.
Okay.
And so that's what we call an indecision candle, where it's not really giving you a direction of where it's going. But the next candle is very telling because it opens up, it goes all the way up but can't close, comes all the way down, and then close right where it opened. That tells us that right there, it tells us that it's going down. And so that's exactly what happens. It starts to go down.
Okay, thank you.
Yep.